So listen guys, if your backtesting looks perfect, you probably did it wrong. So let me show you how real traders backtest and why backtesting alone won't make you profitable. Let's get it. All right guys, so there's a whole lot of misconceptions on backtesting, how to do it, what it even is. It's a big mess. But listen, this is what we need to understand what backtesting is. Backtesting is probability discovery, not profit prediction. And it's going to answer three main questions. Does this setup have an edge? Number one. Number two, how often does it work? And number three, what drawdown should I expect? These are the things that backtesting are going to answer for you. And make sure you understand that, guys. Now, what backtesting is not going to do or not going to guarantee is a couple things as well. Backtesting will not guarantee future profits. Number two, backtesting also won't prepare you emotionally. And number three, backtesting usually doesn't account for any errors like slippage or doesn't even account for spreads, to be honest. So in an effort to really understand how to backtest effectively and properly, there are a couple rules you need to understand in order for you to get the maximum benefit of your backtesting. And listen to these rules carefully. Rule number one, you want to define one exact setup. Again, you want to define one exact setup, guys. I need you to choose a setup that you have had some success with, a setup that you feel pretty confident in, and that is the setup we want to backtest. Or maybe the whole point of backtesting is that you're trying to see if this is going to be a main setup, right? But choose one setup in your backtesting session. Now, with that setup, there's a couple of things you need to know about that setup. Let's start with things like entry criteria. What is the entry criteria of your setup? What candle are you using to enter your setup? What is there a break? Is there a retest, etc.? That needs to be well defined in order for you to understand what it is you're backtesting. Another one is your stop loss placement fully defined? Where do you usually place your stop loss? Is it going to be a structure-based stop loss, which I fully recommend, or is it going to be a fixed stop loss that you usually have every single time that you enter a trade? Make sure that is defined. And the next thing you want defined is the target logic. Like, is it risk to reward based? Are you targeting session highs or session lows? Are you incorporating taking partials? All of those things need to be fully defined before you even start your backtesting process, because ultimately you want to be sure that you have all the information for your strategy so that you can implement that into your backtesting. So in my particular case, my strategy is called BC30, and my BC30 strategy is exactly what I would be backtesting if I'm in a backtesting session. And here's some information about this particular strategy. I know that with this strategy, I need to do top-down analysis from the daily time frame all the way down to the 30-minute time frame using support and resistance. I'm going to use that support and resistance, and I'm going to use it to identify areas in which I can box price in, specifically and especially on the 30-minute time frame. Now, after I've done that, after I've identified where I want to box price in, the next thing I want to do is set alerts both above the area of resistance and below the area of support, all in an effort to understand where price is going to break, where momentum is going to come from. Now, on the 30-minute time frame specifically, I want to watch this trade and allow momentum, and momentum coming from specifically New York session, which is where I'm mainly going to trade. I'm going to allow momentum to come in, hit my alert, and then allow that candle to close, whether it's closing above an area of resistance, whether it's closing below an area of support, or whether it was just a wick that came up or came down and retraced back and did not close beyond that area of consolidation. All of those things need to be notated. Now, if it did pass all of those checks and closed beyond the area of consolidation, then that is my breaking candle, and I'm going to enter on my next candle, the candle after the breaking candle, as it's pushing beyond the breaking candle. Do you see how detailed that is? Do you see how I didn't go in the charts to tell you that? You see how I can just tell you with words, because I'm visualizing this in my head. And I need you to really understand the strategy to that degree, where you can verbalize and visualize off the top of your head exactly how you would enter and exactly how it should look like, because that is your A+ setup. That's how you create your A+ setup. Your A+ setup has to be so clear that you can literally talk about it and literally have the picture in your head without looking at a chart. All right, guys. So when you are backtesting, you need to be able to identify these areas, because when you see it, because you already see it in your mind, when you see it on the chart, it's that much easier to identify, yeah, there's an A+ setup. This is where I will enter. Now, rule number two, You need a minimum sample size. Man, this is one of the biggest issues traders fall into. They don't have enough of a sample size and they judge a strategy based on just a couple losses, and all of a sudden, yeah, the strategy doesn't work. Doesn't work for me. Maybe because you over leveraged, because you blew your account, because you didn't execute it properly. But again, there's a problem that many traders face. So here's a rule of thumb. 50 trades should equal a learning phase. It's a decent sample size, but not enough of a sample size to make a solid determination. So the first 50 trades, you're really learning the strategy, learning how to execute it, learning how it works, etc. Now, after 100 trades, we're gonna call this usable data. Okay, so after 100 trades, you have usable data in which you can use to make a determination on whether this is a very profitable strategy or not a profitable strategy. Now, 200 trades and beyond, we call this statistical confidence. This is where you have used enough of a sample size to be very confident in how effective your strategy is. Now, you see how many trades it really takes to build enough confidence in one particular strategy? That's how you need to go about and move when it comes to testing a strategy, guys. You cannot let just one losing streak or let your over leveraging determine whether a strategy is effective or not. You actually have to use a good enough sample size and follow the rules when it comes to that sample size, right? Not 200 BS trades. We're talking about 200 trades where you followed and executed correctly based on the strategy. Now, rule number 3. You want to track more than just the win rate. I know the win rate is exciting. We want to know how often it's going to hit. Effective backtesting says you have to track way more than the win rate. Here's a couple things you need to track. I need you to track the risk to reward. I need you to track the max drawdown that you usually see. I need you to track consecutive losses. How often does that happen? I need you to track your best and worst weeks. And lastly, I need you to track session performance, because sometimes we're just backtesting any data that we see, but also it does matter the data that's coming from the specific session that you need to trade or that you usually trade. Traders make some of the biggest mistakes when it comes to backtesting. Sometimes they skip losing trades as if they didn't happen. Sometimes they only backtest trending markets as if they don't trade choppy markets, because you know you do. And one of the worst mistakes, hindsight bias. Yeah, I would have entered there. Yeah, I would have entered there. It's usually a lie. No, you probably wouldn't. You're not accounting for hesitation. You're not accounting for your emotions. You're not accounting for the actual live market environment. If it's choppy, if it's a news day, etc. You're not accounting for so many things that you can't necessarily backtest. Now, I know I criticize a lot about how traders are not backtesting correctly, but how do we solve for this, right? Here are a few ways that we solve for this. Number one, we start forward testing as well. What that means is we need to start incorporating the live market environment. Why? Because emotions come into play in the live market. A lot of things come into play that don't come into play when actually backtesting. Forward testing allows us to trade with live rules. It allows us to track execution quality, and it allows us to journal our emotions, how we felt while we entered that trade. These are things you cannot do with just backtesting alone. Another thing we could do to better backtest is to choose only A+ setups. Make sure you are only trying to enter A+ setup, not necessarily every single time you see the setup start forming, but whatever constitutes to an A+ setup for your strategy, that should be the only thing that you're trading. You should also know what is your max amount of trades per session, your max amount of loss per session. All of these things need to be well documented. And now when you incorporate that with your back testing, now you have a more realistic back test. Also, the next thing you want to do is expect a lower performance when it comes to live trading. If you back tested and you realize the win rate for the strategy you're testing is 60%, expect and write down that in live testing, you're expecting a 50% win rate. Usually when live trading, your performance is going to slip a little bit versus what you had back tested. Be more realistic and write that down. Even your risk to reward. Sometimes you think you'll take a full move when you're back testing it, but when it comes to the live environment, you really cut the trade short. So if in the back test you're recording a 1 to 2 risk to reward, maybe in live market environments, it might be more like a 1.5. Now, the last tip that I'll give you, which is a pro tip, is to stress test your strategy. This is what I want you to do. I want you to remove the best 10% of your trades. Then I want you to trade only your worst sessions. Next, I want you to increase your stop loss slightly. And then I want you to reduce your risk to reward. Now, if this strategy still survives this stress test, then it is confirmed that your strategy is pretty solid. These are the ways in which you can improve your backtesting and overall improve your confidence in your strategy. All right, guys, so don't be like many traders, acting like you're backtesting, acting like these are going to be the real results of your strategy. And when it comes to the live market environment, it completely changes. Why? Because you're not effectively backtesting. Ultimately, understand backtesting does not build your confidence. Consistency does. So make sure you are consistent in everything that you're doing and follow these tips if you want to effectively backtest and start seeing results in your trading. All right, guys, I hope you guys enjoyed this video. If you did, please like, share, and subscribe. And if you're interested in joining our group, the link is in the description. And until next time, guys, peace.